Hello, and welcome to another webcast in our Energy Webcast series. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Year-End Financial Reporting and Accounting Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to turn it over to one of today's presenters, Megan McFarland, Partner and Oil and Gas National Practice Leader at Moss Adams. Megan?
Good morning or afternoon, depending on where you're calling from. It's afternoon here. And welcome. I apologize to those who are expecting Julie in this spot. Quick last minute change. I'm here for Julie, and we'll miss her knowledge and presence, but do our best to deliver a quality experience. So speaking of quality, I'd like to turn it over to Jordan Whitten.
All right, thank you, Megan. I appreciate the opportunity to speak with you all today, and I apologize for the voice, and I will do my best to not cough, into the microphone. I don't want to cough into the microphone and get any of you guys sick. That's not the goal, or I don't want you to have to hear that horrible, horrible sound. So please bear with me. Our goals today are really to increase our awareness of some updates to recent accounting pronouncements. There haven't been a significant amount of changes or updates from standard setters. Standard setters pretty much took a seat, and it came to a halt really after the COVID pandemic. So starting around that time in April, really. However, we do want to talk about some highlights and highlight some existing standards that have been out there or a little bit more recent, and how they'll apply to the energy industry in the coming year, and really bring attention to those things. So we'll begin as well with my official statement regarding 2020, and I want all of my bosses to know that this is not the firm's official statement. So on the left there, you have my 2-month-old son, Jack. In the middle, you have my 2-month-old son, Jack, or me on a flight home from a meeting of some form, depends on who you talk to. And then on the right, you have my 2-year-old son, James. And so to me, they pretty much sum up 2020. You can either close your eyes and sleep through it, which is definitely what I would choose, or put on your sunglasses, grab your guitar, and try to rock and roll. So that's kind of what we face. So Those are them, and remember that whenever you're filling out your evaluations of your speakers at the end of this, those guys need to eat, so thank you. First polling question. Amy, sorry.
All right, thank you, Jordan. So we're going to start our polling questions off with a fun one. So our first one is, my favorite holiday movie is, and your options, A, National Lampoon's Christmas Vacation, B, Elf, C, It's a Wonderful Life, D, Rudolph the Red-Nosed Reindeer, or E, Die Hard. And we'll give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. Also, if you have any questions during the webcast, please submit those using the Q&A window found in your console. And it looks like most everyone has responded. Okay, Jordan, here's the results.
All right. Well, thank you, guys. I applaud our Die Hard fans there. Definitely a holiday movie. Christmas Vacation, I would agree, however, would be the winner in my heart. So where we're at with the FASB, as I mentioned, we're on hold for the moment. In May, the FASB met, and there were whispers and notes from the meeting of potentially delaying and pushing back the required implementation date for really the two most substantial standards we've had, or updates we've had, at least in my career and certainly in the last 10 years, with revenue recognition and leases. Obviously, the public companies did not get any such relief. So in June, they did issue an update to that to push those back and really push the implementation date back on 606 and 842. So 606 was required for private companies for the most recent year, for 2019 fiscal year end and calendar fiscal year end, excuse me. And so that delay was for anyone who had not yet issued their financial statements. That really benefited off calendar year companies, or anyone who has a little bit of a longer leeway on issuing their financial statements timing wise. We'll talk a little bit about leases as well. So leases will for all private companies will be effective for fiscal years beginning after 12/15/21. So for calendar year end companies, private companies, it will be fiscal year end 22 is when that will be required. Megan, if you want to talk about
in
LIBOR
here real quick. Yep, that's me talking over Jordan. That's what I do.
Hi, I'm
LIBOR, just real quick. The FASB tried to give a little relief as LIBOR is kind of being phased out, and obviously we use LIBOR with loans, derivatives, and some of our other financial contracts. So they basically addressed some issues relating to the transition that impact contract modifications and hedging relationships to try to make it a little bit easier on folks to comply with that. And that's effective immediately and can be utilized up through December 31st, 2022. It's an optional election and really just providing relief for that transition.
Thank you, boss. So really the goal here was the FASB trying to give relief across the board. They understood that resources, financial and personnel resources, were really at a premium throughout the year, and actually acted really beneficial in a beneficial manner for the company. So that was the goal there. So a quick reminder on revenue recognition. I would hope, and I believe that the vast majority of companies have previously implemented this. So that deferral, which came out in June of 2020, again, deferred those reporting periods for private companies which had not yet issued. Initially, that was going to be a little bit more narrow, and they expanded it to all private companies which had not yet issued. As a reminder, the impact, and I apologize, here my knowledge on 606 and in most things is a little bit narrow to oil and gas companies, but the impact for oil and gas companies is primarily in upstream oil and gas companies. It's primarily presentation of disclosures, that principal versus agent criteria, and the netting your gas gathering arrangements or grossing them up, really determining when control transfers on those arrangements, those complex gathering and processing arrangements. And then there's so much data out there and so many examples out there from the public companies. When in doubt, borrow. It's not stealing. It's public information, so you can go and borrow. A reminder on leases, which is a much more, in my opinion, particularly for oil and gas companies, a much more extensive standard and much more involved and impactful. So again, this one was deferred for fiscal years beginning after December 15th, 2021. Quick reminder that a lease is going to convey the right to control the use of an identified asset for a period of time. So that identified asset does not need to be like a SKU number on a vehicle, but it can be a Chevy pickup truck, a Chevy X number of horsepower truck or something of that nature. So the real goal here, and this thing has been in the works almost as long as I've been in the industry, really, but in 2013 as well, they issued a proposed standard. So this has been a long time coming, and the idea is to bring all those off-balance sheet liabilities on to the balance sheet. How much debt, how many obligations, and the value of those obligations was sitting off balance sheet, and so investors were unaware of them to an extent. I think, excuse me. I think as well one of the real areas of focus is to evaluate your service contracts and all your other agreements for potential leases. I think that this is one of the most challenging aspects of this lease standard is what are our actual leases, and I think we have so many agreements that we believe to be service contracts, but if we were to actually dive into them, it may not meet that criteria under the new leasing standard. We also have to identify these lease and non-lease components within each agreement. Say a lease to rent a building, you will have your rent, your monthly rent, but as part of that service, you're going to get cleaning services or access to common areas and all of these things. So pulling some of that stuff apart, or with practical expedience, bringing them back together. One of our other areas here is short-term leases. Term, the definition of term under the new standard is extremely important. It is not simply the contractual term on there. It's much more complex as far as renewal options, which are probable to be exercised in some of those things. So we don't get that quick just pass of, it's a 12-month lease, which those leases which are 12 months or less do not have to go onto the balance sheet. There is still an accounting policy election we can make by class of asset to exclude those from the balance sheet. So again, that is for leases 12 months or less, we can elect an accounting policy by class of asset to not place those on the balance sheet. There are also some practical expedients. There's the package of practical expedients upon transition, where we do not have to reassess existing contracts as to whether they contain a lease. We don't have to reassess their lease classification or the initial direct cost. There's an expedient to use hindsight with respect to lease term and some of those things. So you take a look at those expedients, pick and choose. Those first three are a package which you have to elect either all of them or none of them. Yeah. And then Megan, you had some chime in here as well.
Sure, yeah. And really I was talking, when we talk about how this is going to impact on the power and utilities renewable side, Jordan has a slide on oil and gas next, but I'll jump ahead. Taking a look at the impact on rate making. In essence, you are still recording the lease on the balance sheet, but there is some relief there where you get to take the timing of the income statement to match the rate treatment. You still have to show it as interest expense on a financing lease, but you do get to take the timing of it against those rate cases. Considering power purchase agreements and think about, the right to direct the use of the assets. Does the off-taker get control and all the economic benefits? So for example, dispatch rights held by the buyer likely constitute control, but it won't in all situations. It'll be contractually relevant. On the renewable side, those same off-taker rights need to be analyzed, but we don't really expect those traditionally. There's traditional curtailment rights in those contracts that we don't expect to convey control. And then finally, on transportation storage contracts, it's consistent with, but on the other side of oil and gas, right, you really have to evaluate looking mostly at substantially all and determine if 842 is going to apply, 606, considering your use of laterals, transmission assets, storage, et cetera.
And there you go. So I forgot to unmute myself there for a moment. So as Megan mentioned, this substantially all is going to really play a part in these determinations in a moment. So what's the impact to oil and gas companies? The most important part here is that mineral leases are exempt. I forgot to mention that when I first gave this presentation, and that was a mistake. Well, I mentioned it on slide 3 rather than slide 2 like I did this time. So we really need to look at our equipment and facilities. Any of our equipment or facilities used in oil and gas exploration or production need to be evaluated. This is what I was mentioning about service contracts. Service contracts, include equipment, right? So when we have a service contract for drilling rigs or compressors or tanks or trucks or shipping or pipelines or some of these things, they all include equipment. And so we have to evaluate if those are identified assets and really dig in on these and see if we have a lease. So remember, we talked about the definition of a lease, but a lease also, a contract contains a lease when the contract contains an explicit or implicitly identified asset, and the customer obtains substantially all of the economic benefits from the use of the underlying asset. So if we have contracts to ship our commodities on these pipelines, and we are obtaining substantially all the economic benefits of this pipeline because we are using substantially all of that capacity, then there's a pretty good chance, very good chance that we have a lease in that instance, and that's something that we need to evaluate. The easements one, so I mentioned briefly that, or I did not actually, I apologize. So there's also another practical expedient where for existing easements, which are the contracts to access land in order to drill for our oil and gas or to access the land where our oil and gas equipment is located. These contracts for existing contracts, we can apply the expedient to keep those off the balance sheet for existing easements. However, if we enter into new ones, we will need to evaluate whether those meet the definition of a lease. A couple of notes here. So evaluate a lease needs to have a term. Some easements are perpetual. So if that agreement, if that easement is a perpetual agreement, then that is not a lease. The other is the substantially all the economic benefit. So if we have access to, or we have a contract to access someone's land for all of our equipment, if they have the ability to graze their cattle or hunt or something of that nature around those wells or around that pipeline or whatever it may be, the pipe above ground, then it's possible and probably likely that we do not have a lease in that instance because we do not have substantially all of the economic benefit. And I think that last bullet point gets really to the heart of this. Identifying, scoping, and evaluating is a really extensive process. And then after adopting, actually, I've noticed in working with companies, evaluating our controls, who can enter into leases. Guys out there will enter into equipment or service contracts pretty regularly or change them and modify them without realizing that they may have changed or modified a lease contract in a way that has a significant accounting impact. So those controls are going to become really, really important, both at adoption and then afterward. And it's really the afterward part that's been interesting for me as I've watched people go forward with this. I'm going to try to speed up because I've been laboring already, as I want to do. Reserve reports, this is an auditing standard. This is not an accounting standard, but it's something I wanted to bring to everyone's attention. And this relates specifically to oil and gas companies. and I apologize for any of our other energy friends on the call at the moment. So previously, we were required to understand all of these, the procedures and methodology for estimating our reserves. We are now required to evaluate management's estimates, not just understand them. Well, back up one moment, if I may, sorry. So this is not yet effective, for periods until those ending on or after 12/15/23. But there are similar PCOB standards already in place, and so a lot of firms have already updated their programs to comply. So you may see this coming your way as you're getting an audit, even though it's not 100% effective yet. And so you're going to start seeing some changes on this. And when your auditors are being more annoying than usual, which is an accomplishment, you'll know why. So, excuse me, this is the coughing part. Apologies. So why is this happening? And it comes down to a really simple thing. Those reserves are the most important estimate on our financial statements. They underline the value of our oil and gas properties. They are the basis for our impairment. They play a role in our ARO to an extent, and really just everything that drives our financial statements. And so that's why it's so important. This change is going to require us to have specific risk assessments around these estimates. We're going to have to independently inquire with engineers regarding their independence, objectivity, skill, and experience. Private companies are not required to have third-party engineers do their reserve report. And so that's where that independence is going to get a little interesting, because if we have an internal reserve engineer preparing our reserve report, it is very hard to call them independent. Their job, it may be very dependent. So that's something to kind of be aware of and know. But there are ways to get around that as far as documentation, the objectivity, right? Even if they're not independent, they may be objective. The auditors are also going to likely want to have one-on-one conversations with external engineers. Previously, we've had a lot of those conversations with internal engineers. We're going to have to step outside of that a little bit more to those external engineers. As we're all well aware, and maybe just me, engineers love talking to accountants and love us asking them about their extremely scientific estimates and their methodology. And so that's going to be a little bit of a unique situation. The controls, both internal and external, how are we as the company confident that what we receive from the third party is accurate? And how is the third party, what third party controls did they have to make sure they got it right? We've never really gone to the third party's controls before, so that's going to be interesting as well. We're going to look at inputs, the inputs being the pricing, primarily, obviously, production, existing production, the costs, both our capital costs and our operating costs. That's really going to continue to be our focus, but it's going to be more robust. One last thing here, and this one's going to be interesting across the board, is the impact on PUDs, right? We're going to continue, there's going to be an increased focus, not we as a firm, but the industry. There's going to be a focus on PUDs, including those undeveloped reserves, because we have to, management will have to consider that management must demonstrate the ability and intent to develop those PUDs over the next 5 years. This will likely receive increased scrutiny if there's been no shift from the prior year reserve report. So that is, I would wager it is very likely that no one drilled any of their PUDs, or a very, very small number of their PUDs this year. If we have not adjusted our timing or estimate on those PUDs going forward, that indicates that we may not, be 100% accurate with our estimate, which it's an estimate. They're never 100% accurate, but that's an aside. So some areas that we're going to look at for related specifically to COVID or issues caused by COVID, perhaps, are going concern, the impairment, debt modifications. So those are all things we'll talk about, specific accounting guidance and some things that have happened there. The collectability on receivables, that's going to be an issue of focus as well, particularly our JIB receivables, and being able to collect those, and then making sure that our impact disclosures are accurate and appropriate, right? I think there's been a tendency to say COVID has resulted in decreased energy prices and demand globally. The impact cannot be estimated at this time. That may be true, but we need to go a little bit further with what the impact has been to date and what it may be going forward. And I believe we have another polling question, Amy.
All right, so our second polling question is: the most surprising thing included on my JIB statement since the COVID-19 pandemic has been A, cleaning costs, there's a error there, B, catastrophic overhead, C, shut-in fees, D, other, or E, what is JIB? And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And we'll give everyone another moment here to respond. Okay, here are the results.
Thank you, ma'am. Other. I wish I had been a little more specific there. That's interesting. I've recently come across a couple of these. It's been which have been new to me. It's interesting, and I would like to talk to some of y'all afterwards. So our contact information will be in there. All right. So going concern. This is historically the auditors were required to assess the entity's ability to continue as a going concern for a period 12 months from the balance sheet date. Management has now been required to do that. So they're not putting as much of the burden on the auditors, and so management has to assess this. We have to assess whether conditions or events raise a substantial doubt, and if substantial doubt exists, or conditions indicate substantial doubt exists, then we have to evaluate management's plans to overcome those. So this is saying it's probable the entity will not be able to meet its obligations as they become due within 1 year of the date of financial statements. So this is a quick little note here from I went and looked. So all the oil and gas 10Ks issued subsequent to April 1, 2020. Of those, 23 received a going concern opinion. 7 had only a footnote, and 1 had neither. Now, I will also acknowledge here this is happening at the crux of the downturn, right? If we start from April 1, 2020, so it's also a small sample size. I just thought it was a little bit interesting. Once this happened, how heavily the impact has been on going concern. So if people start asking you about it during your audit this year, it's basically saying you're not alone. So this is from our Q3 filings as well. Obviously, with the quarterly reports, there is no audit opinion, but they still have their footnotes. So of those, 42 of those companies did have specific footnote disclosure regarding substantial doubt. 98 did not. And then a little bit, obviously, this weighed heavier on smaller market cap companies. So why should we care about this substantial doubt? So a going concern opinion can have an impact on your financial statements, and not just on the financial statements, but on your operations. It can impact your ability to access capital from either debt or equity investors and owners. They may have impacts on trade deals. It's also a very emotional discussion sometimes. Management thinks that we're saying they're not going to make it, and that's not the case at all. It is simply that events have occurred which make it, which are giving cause of concern here. It's not a death sentence laid down by your auditors. It is instead a warning to investors and lenders. So the standard requires an evaluation every reporting period by management So it's 1 year, as I said, from the date of financial statements, and it requires specific disclosures when we raise substantial doubt, and then management has plans to alleviate that substantial doubt. So if that occurs, we are required to disclose that. Let me see. Oops, we'll get back to this in a moment. Sorry. Well, shoot, I guess not. We'll get to it in a moment. I apologize. Just going to click all of the buttons. So here are some of the examples of conditions and events which may indicate substantial doubt. Obviously, these recurring operating losses, working capital deficiencies or deficits, if our current liabilities are in excess, cash flows, etc. If we're defaulting on our loans, if we're having to restructure debt in order to avoid default. Also, some others, if we have work stoppages, if we have legal proceedings, which are going to do some of these things, a loss of a key franchise, or a principal customer, those types of things could indicate adverse conditions and events for substantial doubt. So when this happens, every year management's required to provide documented evidence, of considering these known events and then how they're going to alleviate the substantial doubt. These are going to include forecasted cash flows and projections, all these things. We can't just say we're going to be able to go out and get more money. It doesn't work that way. We can't say we're going to raise more equity. We can't say that we're going to be able to get new lenders or anything like this unless we have really hard evidence that we have something of this nature. Hard evidence meaning an agreement of some form. So when we get these projections as to how management's going to alleviate the substantial doubt, one of the things that's always pretty common is production's going to go up, LOE is going to go down, and we're not going to have any capital spend. That's really not going to work out that well. We really need to take what's happened, so if we are 12/31 year end, what's happened in that interim date that we're then using to project forward any cost savings or revenue growth or whatever it may be to help us alleviate this substantial doubt. Also, a good idea is preparing a sensitivity analysis. How sensitive are we to a decline in sales or a pricing decline? That's really going to help justify or support this projection and this assessment. Because if everything has to be perfect, that's a dangerous place to be. We, as auditors, are then required to consider whether management's evaluation includes all of this relevant information, right? We can't just say, yeah, looks great, we got to go from there. So when conditions or events that cause substantial doubt are identified, we have to assess whether those plans can be implemented and whether they'll be successful in alleviating that substantial doubt, or it is likely they will be successful. We then have to verify that financial statement disclosures are adequate. And again, it's 1 year from the date of the financial statements, not from the balance sheet date. It's a big difference. This also puts auditors in a weird place. We're historians. We're not usually good at seeing the future. So it's a little bit of an uncomfortable place when we're looking at projections of this way rather than records. So our required disclosures, as I mentioned, and then clicked forward 5 times without actually getting there. When substantial doubt is raised, but it is alleviated by management's plans, we're required to disclose the conditions or events that gave rise to the substantial doubt, management's evaluation of the significance of those events, and then management's plans to alleviate that doubt. That needs to really be a robust disclosure there. Now, that is when substantial doubt is raised, but it is alleviated. When substantial doubt is raised but is not alleviated, we have to have an explicit statement indicating there is substantial doubt about the entity's ability to continue as a going concern. These conditions, the conditions or events that give rise to substantial doubt, and then those same bullet points, but it's that explicit statement. That is the difference there. Something of note here that's interesting is if there is a if substantial doubt is not alleviated and we have an audit opinion that expresses that substantial doubt, I would wager if you look at a lot of credit agreements that is an event of default in some form. And that's why this is such a big deal, because it could put people into a really, really bad place with their lenders and just from a business standpoint. And so that's why management is really encouraged to get ahead of this. It is their responsibility to provide these projections. And so having them prepared in a thorough and detailed and reasonable way is really going to help the process as much as possible. Okay, that's that soapbox. All right, so the other fun thing of the year, and I would be a little bit quick on this one perhaps, is regarding impairment. So public companies evaluate for impairment each quarter. But what happens with private companies? So there's an interesting thought here, right, that well, we'll get into the specifics here, but there are generally three buckets of private companies. There are those that aspire to be public, and their financials may or may not be included in S1. They've done a private placement, whatever it may be. Private companies that are planning some kind of future transaction where they'll want to have those financial statements in a potential public filing, or private companies which essentially report annually. For buckets 1 and 2, we should consider the timing of potential impairment trigger, and if the financials you publish would be impacted in a way that could impact an investment decision. So if that is the case, then you should consider impairing more specifically in line with public companies, which would be effectively quarterly, versus those private companies if you don't meet that criteria, which would more likely be annually. And where this gets to is here, that so the guidance can be interpreted that you should assess for impairment at the time of a triggering event. So we get to March and oil and gas gets to $20 at March 31 of 2020. Do we have a trigger? If we were to assess impairment at March 31, 2020, we have a substantial and significant impairment. I don't think there would be any doubt about that. There's a vast number of impairments. But if you're a private company and you're not reporting quarterly, would you record that at that quarterly time, or would you wait until year end when we've had a bit of a price rebound? And so that's the issue, and that's the issue at the heart of this. And it says that the guidance can be interpreted that way. It's not really hard and fast on this. And so I think it says it there at the bottom. What's been the historical practice? How have we historically assessed impairment? When have we historically assessed impairment? And we have to be consistent with that. We cannot pick and choose that this year we're going to say, oh, well, we'll just wait till the end of the year, whereas in every prior period, we've assessed impairment on a quarterly basis or monthly, which I wouldn't anticipate. But that's the issue at hand. I think if you are consistent, and actually I'll get to a summary in just a moment. So this also plays into a more recent standard that is only for public companies, or this portion of it is only for public companies, which requires the disclosure of the range and weighted average used to develop significant unobservable inputs for level 3 fair value measures. Impairment is based on our reserves or fair value, which is the reserves are in unobservable inputs. So anytime we record impairment, that is not anytime, 90% of the time we record impairment on oil and gas properties, it's going to be a level 3 fair value measure. When that happens, this standard, which is again only for public companies, requires that you disclose a lot of the information or some of the information as to how you came up with that estimate. That has not been the case before, and so it gave an insight. So based on the quarterly Q1 data from some public filers, the average prices used at March at that Q1 tracked NYMEX almost to the penny. The banker pricing at that same time was about 30% higher than NYMEX. Now the bankers are obviously going to haircut that and risk adjust that. The consultants were a little bit lower than the bankers, a little bit higher than NYMEX, up until 2022, when the prices used in their evaluations absolutely skyrocketed. So I think that that's really interesting observation regarding how these public companies are coming up with fair value, and it basically was 9x at the quarter. And there's also disclosure. 70% of those that disclosed a discount rate of 10 or 11%, with an average of 11%. The 11% piece was interesting to me. I had not previously seen that. I had only seen 10%. So what does this mean for private companies? If you run your reserves annually, if you've always done impairment annually, it's probably fine to keep it that way. Really can't object to analysis that is management's estimate applied in a consistent manner. And I think that gets back to it. This is management's best estimate. And as long as we're consistent in that manner throughout, then I think that we have justification. We've got to document. And document. And then was there something here as well, Megan, or am I crazy?
Yeah, so on the pure side, I think just a reminder, a lot of this is based on reserve factors and things like that. But on the pure side, remember your COVID considerations for purposes of impairment. Number one, if you have big goodwill from recent deals, has the pandemic caused a decrease in revenue, an increase in cost, or both that would create a reason to reconsider recoverability of that goodwill? Also, don't forget your renewable projects under construction, timelines, disruption of supplies. Are you going to get your materials and your projects in place in time to recognize the tax credits that may be making those make sense and be recoverable for you? Do you need to look at that? Looking at your capitalized development costs. Are your projects still financeable? Are they still on track? Does it make that project viable? Is it something you're going to proceed with? Or do you need to consider if you need to impair those development costs? The midstream impacts, which are very similar to oil and gas, right? Your prices are up or prices are down. Everybody wishes they were up. The costs are up. Is that making some of your midstream assets and your transportation assets less economic and need to be considered for recoverability? And then obviously your merchant power side, the impacts of the pandemic on demand. How is that impacting your recoverability for those assets? So most of the stuff we're talking about is kind of the same for both sides, but I just want to throw in those little tidbits where there is some impact on the pure side. And I think rolling into debt modifications, Jordan, I think that applies to everybody.
It does. So this one is industry agnostic. So I think we'll get into this, but we have a polling question first. I believe, Amy.
All right. So our third polling question is, during 2020, the most significant change to my credit agreement has been, and go ahead and select A, B, C, D, or E, and hit submit. And for those of you that would like a copy of today's slides, you can download them now from the folder that says slide deck and handout. And we will also be sending the slides via email tomorrow, along with a recording of the webcast. And we will leave this up here for 10 more seconds or so to make sure everyone responds to get their CPE. Okay, here you go.
Thank you, ma'am. So that looks about right. I think that paints the picture. I think the borrowing base reduction, being the largest, and then working down from there, and then the affirmations or increases. That's good information. I'm interested to have seen. Thank you, guys. All right, so yeah, we're good. All right, so you saw on the previous slide this. I don't know if I can skip back to it without hitting this, but two sets of accounting. Thank you, ma'am. Those two subtopics there: debt modifications and extinguishments, and then troubled debt restructurings. The FASB issued a white paper in October of this year to basically say, hey, this is their exact statement, actually, and I think that it's interesting. The FASB staff understands that many entities have not previously apply the guidance in subtopics 4, 7, 50, and 60, but because of the effects of COVID-19 pandemic, there may be increased modifications or exchanges of outstanding debt arrangements. So they basically issued this white paper as a reminder of, hey, I understand that all of you are going through this period of time. We understand that all of you are going through this period of time with your debt. You're modifying your arrangements as the poll question showed. And we just want to remind you that this guidance is out here. And I just thought that was really interesting and seems to be a sign of what they expect to see or any regulators would expect to see. So this is pulled directly from that white paper, and you can even more clearly see the intents here where they say debt modifications may include any of the following. And so we're reducing the stated interest rate, extending the maturity date, or reducing the face amount or any interest, right? A debt modification may be more than those things. It may be an increase, we may extend the maturity date or something of that nature, right? We can increase the borrowing base. It need not always be these somewhat negative modifications, but that is the FASB sending a signal there as to what they expect. So this slide, and I hope you all are able to see it well, really, to me, is a great slide, and I really like the flow chart as to how we walk through this. So we had the two subtopics there, and we have to say, we've modified our debt. Is that debt modification a modification or extinguishment, or is a troubled debt restructuring situation? So we have to decide if it's troubled debt restructuring first. So we have to evaluate, is the borrower experiencing financial difficulty? Yes or no? If no, then we just go to the modifications and exchanges. Did the lender grant? If yes, did the lender grant a concession? If yes, then we have the troubled debt restructuring guidance. If no, then we go to the modification. So if it's no to either one of those first two questions, then we go to the standard modifications guidance. So we'll start with the troubled debt. So when we say what constitutes a troubled debt restructuring, we have to say yes to financial difficulties. So here are some examples as to what constitutes a financial difficulties. If we're in default on any of our debt, if we've declared or in the process of declaring bankruptcy, if there's significant doubt about going concern, if our securities have been delisted, etc. And then this last one, absent the current proposed modification, the company cannot obtain funds from other sources at current market interest rate for similar debt as a non-troubled debtor. So if we're unable to go out and get debt on the marketplace, then that would indicate that we are experiencing financial difficulties. Absent those previous criteria, if we are currently servicing our debt and can obtain funds to repay the old debt, and the lender agrees to restructure the debt based on decreasing market rates or changes in our credit, positive changes to our credit worthiness, then we are not experiencing financial difficulties, and we go on over to the debt modifications and extinguishments. So again, we had, in order for it to be troubled debt, we had to have financial difficulty. We also had to have lender concessions. So this lender concessions part gets extremely mathematical. It's a little bit interesting. So we have to project out the cash flows under the new terms and then solve for the effective rate, or we solve for the discount rate to get those present value under the new terms that equals the current carrying value of the existing debt. That's a little complicated. So we project all the cash flows under the new terms and then solve for the discount rate so that the present value of those cash flows under the new terms equals the current carrying value of the debt. If that new effective rate is less than the old effective rate, then that modification is a troubled debt restructuring. It should be accounted for according to the troubled debt guidance. I have not added all of the troubled debt guidance in here because it is extremely technical. I'm happy to talk about it with anyone that would like to, but there's a series of things that we have to walk through in this. But at the end of the day, it gets a little bit odd. I won't lie to you there. All right, so standard modifications. So if If we are not experiencing financial difficulty or the lender has not granted a concession, then we look at these changes, we look at these modifications as to whether they are an extinguishment or whether they are a modification. So if we get a new lender, if we pay off our existing debt or settle our existing debt and have a new lender, then that's an extinguishment with a new lender, obviously. If we have an extinguishment with the same lender, so if we exchange our debt arrangements with our current lender, I should say lender rather than leader, with substantially different terms, so we exchange arrangements with our current lender, or we substantially modify the terms of the existing arrangement. And we'll get into what is substantially different or substantial modifications. That would constitute an extinguishment. If we determine that it is substantially different with the same lender, we record as an extinguishment. We record that new instrument at fair value. We use that fair value to determine and compare that to the current carrying value of the existing arrangement. And any difference there would go to gain or loss on extinguishment. So we record, if we determine we have the same lender and the terms are substantially different or a substantial modification, then we record that new instrument at fair value and take the difference between the carrying value of the old one and the fair value of the new one as a gain loss on extinguishment. Interest expense is recognized using the new effective rate, and we go forward. If it is not substantially different with the same lender and we have a modification, then we have to determine the new effective interest rate. And we go through that as well. The guidance has a specific definition on that as well, and it can walk you through that. In that instance, we would not change the face value or carrying value of our debt or anything of that nature. All right, so what constitutes a substantial modification? With term loans, it's pretty straightforward. 10% cash flow test. So a substantial modification with the same lenders is when the present value of the cash flows under the terms of the new arrangement are at least 10% different from the present value of the remaining cash flows under the terms of the original arrangement at the modification date. If the terms of the debt arrangement are changed or modified at that, and the modification is less than 10%, then it's not considered to be substantially different. And that's where we get to the modification part, right back here, right, the very bottom one. So if it is not 10%, if the cash flows are not changed, if the present value of the cash flows is not changed by 10% or more, then it's a modification. That's that we just went over. All right, so one with substantial modification with revolvers, lines of credit. So line of credit, this is when we modify an existing line of credit and either enter into a new line of credit or revolver or into a traditional term loan. We can compare the borrowing capacity of the old arrangement to the new arrangement. What is our borrowing base? What is our borrowing base and the term under the old arrangement, and what is our borrowing base and term under the new arrangement, or straight up a term loan. If the new capacity is greater than the old capacity, then we defer and amortize any unamortized deferred costs, lender fees, and third-party costs over the new term, over the term of the new arrangement. If the new capacity is less, then we will write off unamortized deferred costs relating to the old arrangement proportionately. So if we had deferred financing costs and the new capacity is less than the old capacity, we would have a proportionate write down of the old deferred fees and then amortize the new ones, the fees incurred as part of this amendment or new facility, and defer and amortize them over the life of the new term. And then we have our last polling question. Please, ma'am.
Okay, our last polling question. Our presenter, A, is hilarious, B, reminds me of a young Leonardo DiCaprio, or C, sounds like Darth Vader trying to breathe. and we'll give you a few moments to respond to our last question for CPE. And once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE Progress window. And if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. And Jordan, I know you're anxiously waiting for the results on this one. Give everyone a moment to respond.
Oh no, I promise. I'm the one anxiously waiting.
I had to hit mute. I had to hit mute so I wouldn't persuade anyone with my breathing. Well, the fact that
okay, here you go.
Hey, that's just hateful. I tell you, but I agree. A young and dashing Leonardo DiCaprio. I agree. And some people don't know comedy. What can I say? I tease, I kid. And I do apologize for the voice. So one last comment, and then I'll be done and out of your ears. I promise. There's a lot of changes that have happened with the debt. Again, that polling question, I think there's going to be a lot more work around debt when you're doing your financial reporting this year. It's really important that you get as far ahead of that as possible. There's going to be more questions. There's going to be more work, and really just communicate and provide all those documents. Communicate. That's really the key on this one. And then I think the rest is, we discussed this earlier, and then I'm not 100% certain we have any time for questions, but I tried to rush at the end there. And if not,
thanks, Jordan.
Go ahead, Megan.
Yeah, we actually don't have any unanswered questions at this point, but I would take this opportunity to thank Jordan for pushing through this presentation with his obviously compromised sinus system. And thanks for pushing through and getting it done for everybody to share this information. If you guys have questions that you haven't asked or would like to ask, our contact information is actually next to our headshots on the left-hand side of your screen. So you can reach us there. Either one of us are happy to help you. And if we didn't have time to answer your questions, which I haven't seen any, certainly we're happy to take care of those after. So at this point, I think, Amy, I turn it back over to you.
All right, thank you. And thank you, Megan, for stepping in for Julie, and Jordan for your presentation today. And I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And there's also a link in your console to visit our website for all of the recordings from our Fall 2020 Energy Webcast series, so make sure to check that out. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete your survey, as your feedback is very important to us. Thank you for joining the last session of our Energy Webcast series. We hope you'll join us again next time.